How about now? Test, test, test. I'm not sure if anybody's hearing me now. Hope. It was pretty bizarre. Mr. IDK, good morning. I've been actually battling this thing for 10 minutes. How crazy it was. It was giving me some API errors on YouTube. But I hope it's resolved. I'm not sure. I don't think I've done anything to fix it. It was just fix it itself. Okay. Um, Beautiful. And thank you. Thank you. All right. So, and good morning, Scorpion, as well. So let's go first of all over the bonds. Please ask questions. Questions are very, very important. Can we say that this week was fruitful for the Ghost DAO? Maybe. Maybe yes, maybe no. So the pricing went down. So I'm confirming this with the Excel spreadsheet where I'm taking some notes. So around a week ago, I believe it was February 28th. So the price for one eGhost was $300. So this price was $300 here. Now the APY has been higher. So the APY has been at, it will take some time to load, but I think it was about 12,000%. And we are 20,000%, sorry. And now we are dropping this slowly to 15,000. Now every single change to the protocol when it comes down to creating bonds, adjusting reserves, and also set adjustment, which is impacting the APY number. All of these proposals have been public. Okay, so all of them can be found here on the governance, and you can vote for them. Of course, as we've mentioned before, they need some improvement, potentially. So maybe we need some hovers over just to give a much better picture of what, say, this gray line here represents, such as this is the needed quorum, and clearly the vote has been surpassing the needed quorum. We also see very important the badges, we call them medallions. So executed is the highest order medallion, so it means that the transaction has been successfully executed. Now succeeded means something interesting. It means that the majority did vote for this proposal, however, so therefore it succeeded. So everybody, not everybody, but well, in this case, everybody, it's purely green. Everybody who voted yes. And the vote is far surpassing the quorum required, which is the gray line. However, if we go to the view, how come it succeeded and how come it's not executed? So let me click on it. Okay. Again, the numbers will load. So you see the execute button is active. So technically anybody can trigger it. Anybody can trigger it. We can see that the minimum quorum required was 10%. Total votes have been 85.9%. So 85.9% votes voted yes, which is about 50% of the majority, of the simple majority. Therefore, the proposal just instantly goes through. Now, why did the execute button is still active? Like, why is it not, why this specific proposal has not been executed yet? So as you can see, this proposal consists of three functions. So audit, reserve, set adjustment, and create. When it comes down to audit reserves, that's easy. That's just to update this number here. Right? So, by the way, the preloaded numbers that you've just seen, 0.03, 0.010, whatever, that is in Ethereum. And then we are pinging the APIs from CoinGecko, Binance, and CoinMarketCap, I believe, to get the dollar denominated prices. So the audit reserves is updating this number here. So this number right now shows $70. In reality, it's $80. That's the RFE value. Now, let me tell you how much the risk-free value is. So the RFE value, based on my notes, is $80.24. Okay. Now the MV, the market value of each eCasper, as we discussed, is actually much higher, it's $133. So so you can see that, okay, first of all, the price is $199. The back end is 70. And when we look at the bond, the current bond could be purchased at 101. Since it can be purchased at 101, that presents a massive discount of 50%. Maybe it makes sense to purchase it. Maybe it makes sense to purchase the bond because honestly, it's below the market value of $133, which is quite insane. And it's still massive discount to the market price. So in any case, the RFE is not updated. It's $70. It's supposed to be $80. And the audit reserves function is responsible for that. Okay, so that's straightforward. Now, create, we can look at what create has been. So create has been to create an LP bond. So here's an LP bond. True for both booleans, representing capacity is measured in the quote token, which in this case is LP token, and also booleans here, which is each purchase matures after vesting duration from its purchase. So whatever the duration is, every single bond after the bond has been purchased is vesting for a fixed amount. We'll see what that fixed amount is. Now, the market capacity. So these numbers are quite difficult to convert, but if you have the value for the market value, which can never be found on the can nowhere be found rather on the user interface, has to be calculated internally using public functions. By the way, all public functions are all available on smart contracts. But that's Olympus DAO legacy. We're just following that legacy. So the market capacity is measured in this many LPs. Now, you can say, well, that's a lot of LPs, but this number has to be divided by 10 to the power of 18. So 18 zeros, essentially. So this number is quite tiny. However, one market value, so the market value of one LP today, based on my calculations, is equal to, let me tell you how much. Let me tell you how much. So one LP, just give me 1 second, ladies and gentlemen. Yeah. So one LP, the market value of just one LP today is equal to $46,398,746. Quite a lot. So even if this capacity seems tiny because it has to be divided by 10 to the power of 18, when we then multiply this by 46 million, the true capacity for this bond in dollar terms, in DAI terms, therefore, was $1.3 million. Okay, so you have to essentially figure out the token value. Token value is quite easy to find. You go to Treasury smart contract, think token value, have that, multiply that token value by this number, and boom, you have it. Now, market. This is the initial price. The initial price was set close to the market price. Now, again, what is this price? This price, 5815, has to be divided by 10 to the power of 9, and then you have to multiply that by the price of LP. And this was, I know for sure, was set close to the market price at the moment, like market price of eCasper. Now, this one is 5%. So it says 5,000%, but it's really 5%. So because 30,000, like essentially 10,000 is equal to 1%. I said it wrong. 1,000 is equal to 1%, and 5,000 is equal to 5%. What does this number mean? What does it represent? It represents a buffer. The buffer required to, like, as a discount to the price, to the current price, to the initial price rather. So we take this initial price and we say, hey, listen, we are expecting, as part of this bond, for this bond to be sold with 5% discount on average. So maybe somebody will be buying this at par, at 0% discount. Somebody will be buying this at 10% discount, roughly par. Now, it doesn't work just like that. It has some, how to say, it does not like limit anybody, and therefore like the average can no longer be lower than 5%. It can be, but the function on the back end is optimizing for the buffer. This is called buffer, for the buffer for the overall discount to be roughly 5%, although that may not necessarily be realistically true. To tell you why that may not be true, let's assume currently the discount is 48%. Now we can purchase a huge quantity. In this case, it's limited to 57 Casper, e-Casper, and 45 Casper. So we can purchase 45 Casper in this quantity. Let's assume after this purchase, the bond's capacity is X'd out. So the thing is, this max payout, this number is called max payout. Max payout is how much you can, how much a user can purchase per one transaction. So this number tends to increase over time, closer to the. It increases as the bond matures closer to its maturity tautology here. So let's assume that instead of 57, it would say 5,700 e-Casper could be purchased at 50% discount. Thing is this, while the function is trying to optimize for the 5%, since the max payout increased so much, nobody can really prevent anybody from not purchasing 5,700 worth of e-Casper if the user has that much funding in LPs. So in that case, obviously the discount will be vastly minimized and vastly converted to roughly 48%, right? Because all the other purchases have been much smaller at lower discounts. Now this is a pretty huge discount, and a huge amount could be purchased. After that amount is purchased in, likely the bond will just X out. Likely the bond will discontinue because the entire capacity has been purchased. So what I'm trying to say is, like, it's a pretty flexible term structure of the bond, where the closer it gets to maturity, the higher is the payout. And the higher is the payout, the easier it is to diverge the discount and make it lower on overall. So all bonds, and there's nothing that can be done except for significantly extending duration, maybe for, instead of a week, maybe extended duration for 1 year. In that case, the bond will not be dropping that fast, and also increasing the tune from, let's assume, a couple of hours to like a month. In that case, the bond will not be very sensitive to purchases. In that case, the discount will be moving extremely slow, but the buffer will be more stable. So essentially, if we extended the tunings, which I'll show you in a second, if we extended the duration, then yes, potentially, and that's something to experiment with, potentially we can get closer to the 5% overall, because the discount will just be dropping very slowly. Like maybe after a week, the discount will not be 48%, but it will be 0.1%. After a month, the discount will be like, I don't know, 2%, 5%, right? Now here, within a couple of days, we have 48% discount. It's too sharp. Again, the only way to control the potential is to increase duration significantly. But then when we increase durations significantly, we make the bond less flexible simultaneously. So it's a balancing act of setting up these terms. But just to reiterate the point that the 5% buffer will not necessarily be enforced, right? That's what the bond is trying to get to, but will not necessarily get to. I'm personally yet to work on these benchmarks to see what the target discount has been versus the actual result. So that will be very interesting for me personally. I'll report it once I have it. But yeah, so just to give you an idea again, the buffer is the average discount expected on the across the board purchase. Okay. Now intervals. So those are the intervals that I just mentioned to you a second ago that could be significantly increased. So for example, this one is time in seconds that determines per transaction by purchase limit based on time until expiration. So that's max payout. That's what the max payout depends on. So the lower this number, the lower is the maximum purchase you can buy. So essentially, interval 0, so this first variable parameter here, is responsible for is acting as an anti-spam measure against whales, so that even if whales has lots of money, whales must be splitting the huge quantity, huge amount, huge TVL into multiple transactions, thus enabling other players as well to participate. So a whale can certainly trigger many transactions in a row. However, those transactions must be treated more or less independently, and therefore that creates a window for smaller players. So this one is an anti-spam measure, and that's what I was referring to. That this number 3600 stays the same, but think about this: it's 3600. Kind of like the best way to understand it is 3600 in this case divided by time until expiration. So let's assume it's 1 week. So imagine how many seconds that is, like a lot. So therefore, the proportion per purchase is very tiny. It's 3600 seconds over lots of seconds in a week. But now let's assume it's only 1 day remaining. So now it's 3,600 over 1 day in seconds, right? So now you can buy 7 times more. So before the denominator was 7 days in seconds. Now the denominator is just 1 day in seconds. So the max payout just increased by a factor of 7. Then, of course, within a day, let's assume it's only 12 hours remaining. So now it's only 12 hours in seconds in denominator. Therefore, the max buyout just doubled compared to a daily maturity. So that's what this very parameter is responsible for. Now, this parameter interval 0, that's for tuning. That's exactly what I was just saying, that this is actually one of the most important ones. It's responsible for the following. So we have a linear progression for how this bond needs to be sold based on the buffer. So we're expecting, okay, we need to sell 100 eCasper, okay? But since the buffer is 5%, we expecting to sell 105 eCasper. Okay, cool. So we're expecting to sell this over 1 week. Oh, actually, the numbers work really nicely. So we're expecting to sell this over 7 days. So when we divide 105 eCasper over 7 days, we get 15 eCasper per day. Okay, so every single day, the bond is supposed to sell 15 eCasper. So therefore, the user is supposed to buy 15 eCasper per day. Now, two things may happen. Let's assume that every single day, the tuning is every single day. Now, this one is 1440 seconds. I believe that's 4 hours. Let's assume it's 86,400, right? Which represents 24 hours in seconds. So let's assume this tuning is 1 day, right? So then we start on Monday, we finish on Sunday. Cool. So let's assume on Monday, we did not sell 15 eCasper. We only sold 5 eCasper. So then on Tuesday, the tuning will think, okay, we'll tune every single day. So on Tuesday, the bond will say, okay, cool. So we sold only 5 eCasper versus 15. So we have to sell more. So the discount must be aggressively larger, increasing for Tuesday. Now let's say on Tuesday, we also only sold 5 eCasper. So now we sold 5 eCasper on Monday, 5 eCasper on Tuesday. So total 10 instead of 30, because we're supposed to be 15 every single day. So now the tuning on Wednesday tunes to become more aggressive yet again, even more aggressive than on Tuesday. So that's like the first example. Now, a second example, counter example to that, is let's assume same thing, 15 eCasper planned to be sold every single day, but we sold 50 eCasper on the first day. So then the tuning on Tuesday will say, hey, okay, we sold a lot more. So first of all, let's bump the price higher. Secondly, let's drop slower, because clearly this bond is in demand. Lots of people want to buy it. Now, why do we have this weird flexible or whatever functional structure of determining the price of the bond? And Zeus from Olympus said it really nicely. He said that the bond is the way to feed the treasury, and therefore the way for treasury to purchase liquidity through LP bonds in particular. So the bonds act as liquidity purchase. When the bond is initiated, the initial price is known. It's set. Remember, it's set as here. This is the initial price. However, the protocol has no idea what the price is supposed to be. So therefore, the bond with this tuning mechanism is one of the biggest parameters behind the Dutch auction behavior. Okay, so this tuning mechanism is helping protocol determine the fair price of eGhost, of eCasper. So therefore, not only bonds serve as feeding the liquidity function, feeding the treasury function, buying liquidity, acquiring liquidity function, but bonds also serve as identifying the fair price. Right? For example, if nobody's buying, today the price is, well, let's actually go here. So go back. Today the price is $198, right? But the bond is 100. People will start bidding at 100. So maybe the fair price is not 200 per eCasper, but actually 100 per eCasper. So now let's assume the discount will increase a little bit. Let's assume it goes, this bond price goes down to $75, and the discount will probably be around 60%. In that case, the fair price, if at $75 per bond, users will start bidding for the bond. That will mean that the fair price for eCasper is $75, not $200. So that's a great mechanism for the protocol to identify what the price really is, contingent upon current user demand. Okay, so that's quite interesting. And if this does not ring a bell, when you go to, let's assume you are creating, I don't know, let's assume you have your business, right? You don't know how much to charge. So you can charge higher price first for your service. And then if nobody's buying it, you can always start dropping it a little bit. And then when you keep dropping it, people will start showing demand. People will start buying your product, right? So by dropping the price or increasing the price, by manipulating the price of your offering or product or service, you can more or less definitively at a given moment identify the right equilibrium of supply and demand, therefore identify the right price. And that's what the bond does, but programmatically. Okay. And finally, these two parameters here, terms. So terms, times and seconds representing bond vesting schedule. Bond becomes fully claimable after this time elapses from purchase date. So in this case, this, I believe, is 3 days in seconds. So therefore, every single purchase of LP bond will vest over the course of 3 days. Why is it done like that? Let's assume there's no vesting. I can go, there's no vesting, right? I can go buy the bond at the bond price of 0.005 ETH or $100, right? And then instantly I can go on the DEX and sell it for $200. So I can generate my 49.38 ROI. So this number, by the way, was ROI before. It was renamed to discount to make it sound potentially more compliant. But in reality, this is ROI, right? So return on investment. Same thing with this one, right? Same thing with the discount. Okay. So what I can do is, if there's no vesting, I can purchase the bond right now, $100, claim it instantly, claim eCasper instantly, go on the DEX right here and sell it, sell my eCasper for $200 and generate 50% APY. In reality, the APY will be higher. It will be closer to 100% because the discount and premium calculated slightly differently, but it's all about the same thing. Now, in order for the protocol to prevent this behavior from users from happening, the vesting is introduced before you can sell on the DEX for $200. And that way, you are essentially more closely aligning the objective of the user and the objective of the protocol. So you're attracting more long-term users. Now you'll say, wait a second, just give me 1 second here. 3 days is considered to be long-term. First of all, for testnets, so far we experimented with 1 day vesting and 3 day vesting. So on testnets, of course, the vesting will be a little bit lower, a little bit shorter. On mainnets, the vesting is expected to be a little bit more extended, maybe 5 to 7 days. That's what Olympus had done. Whether on purpose or not, I'm not the judge of it. Maybe both. Maybe on purpose plus just business functional technical things. Let's not forget that 99% of projects never came to fruition because they were simply nothing was done. When I say it was not launched, it was like meaning it was not even getting closer to getting launched. Meaning nothing at all was done. Just money was raised and spent. And then we have and from the 1% of remaining projects, some of them were half baked and some of them were complete. So when we look at and say, hey, it's only whatever, up to 50% of pure Web3 projects based on CoinMarketCap statistic. From one perspective, it sounds very tiny, but don't forget that 50 projects represent, not even 1%, probably 0.1% of projects that simply delivered the final product, right? So to be honest, the competition, if you are able to complete the product, the competition, and not just fork it from somewhere else and actually produce some type of utility, theoretically, the barrier to entry in crypto is very low. And again, theoretically, the upside is extremely high. So from that perspective, the risk-reward ratio contingent upon the team is delivering is actually very high. But that risk-reward ratio is significantly diluted by teams who are not delivering. And the best proxy of seeing if the team is delivering or not is to show if they're delivering, right? So how many MVPs they have, how many, instant launches they've done, intermediate launches they've done in the meantime, et cetera, et cetera, et cetera. That's why we, on our side of things, it's a parallel economic structure, right? Like completely new, completely novel ecosystem. And I'm saying that not to pat myself on the on the head, but more to demonstrate the real complexity that we have to deal with. Um, and in order for us to kind of not just deliver everything on the background in the shadow without showing, we are launching lots of MVPs with lots of bugs, and that way the whale community can help test it, and therefore we can uncover bugs faster. A and B, everybody just feels more confident. Okay, that the development is going, and of course we are developing extremely fast. You guys can see the feedback was received from some of you guys who are listening to this call that deliverables right now definitely did accelerate, especially the last 3 4 months, and it's a lot more difficult now to catch up with stuff because we're just shipping stuff left and right. So that was going back to the idea that when we have degens who just go with Pepet token, right, or some Vera chain coin or whatever, like some hot coins, hot projects. Typically, the vesting is nothing. Now, when the vesting is 2 years for the team, again, that meant something, but in reality, it didn't, because again, the team members, through a combination of purposeful delay plus objective delay, due to either the team's inability to complete the task, the inability to complete the task period because the initial white paper was written incorrectly from blockchain perspective, or just some real life situations where team members leave, or there has been a hack somewhere, or just a difficult task. So that vesting of 2 year time typically didn't hold, didn't really help anybody. So what Olympus did is they entered somewhere in the middle. Instead of saying, hey, no vesting, or let's go 3 year vesting, which doesn't save anybody anyways, how about we introduce a pretty short-term vesting, but still long-term enough to align our interests. Now, I believe that 5 to 7 days is still a little bit short, but that also depends. The context when Olympus was launching 2021, most of you guys who were there remember that um, it was lots of DeFi protocols. And lots of DeFi protocols were the first wave of DeFi protocols with aggressive APYs was in 2018. The second wave was around 2021, 2022. Now, the wave of those back in 2018, it was not called DeFi. It was just called like essentially farms. You would still be able to farm tokens, and you will farm tokens without any substance. So you would just inflate the supply indefinitely, hoping that the price will catch up. Hopefully that liquidity will outpace the increase in supply. And same exact idea uh, relaunched again under a different name, DeFi, in 2021. Now, of course, there have been some good DeFi protocols that are sustainable, such as Dexus and Lending Borrowing Protocol. DAI became way more popular. Some algorithmic stablecoins started appearing with, like Frax, for example, with or what's it called? The originator, essentially the originator, like the protocol right before Olympus, that Olympus was inspired by, that was rebasing both up and down. If you guys remember that name of the protocol, please tell me. I sometimes forget things. Um, but so these protocols were solid, but then there have been a bunch of others that introduced, I don't know, 1,000% APY and no substance, like just counting on liquidity to appreciate into the token price. And around that atmosphere, the APY for Olympus probably had to be very, very high. And that's what it was. 20,000%, 10,000%. I remember 10,000% vividly. I think it went up to a couple of million%, at least temporarily. And then that was one thing. And second thing, the competition for DeFi was so high that Olympus could not introduce a longer vesting than 5 to 7 days. It was just not possible because other protocols didn't introduce any vesting, I think, at all. Maybe there was some vesting like a couple days, but like not 5 to 7. So 5 to 7 was actually aggressive for that specific context. Now, if you're going to be launching in the next 12 months, for example, I don't see any DeFi protocols, to be honest. I don't see any meme coin, uh, craziness, right? Like I don't see any of this stuff. Um, Now, of course, it may appear we had multiple waves. We had NFT wave and then DeFi wave, and we had obviously meme coin wave. But unless we have something like that, it may be safe to keep APY pretty, how to say, uh, pretty nominal at, let's assume, 100% APY, 200% APY, which is still high, but not like 20,000% high. And secondly, the vesting could be potentially increased to maybe 10 days or 14 days or maybe even a month. Of course, that will be decided by each proposal by the governance. So whether the governance is on the Ghost DAO or on the Ghost chain, but that was that. Okay, now let me finish this last point, and if you guys have any questions, please shoot them up. Would be nice to hear. I know that I'm rambling about some stuff which may not be very exciting to most of you, but believe me, it is exciting as far as the results. Finally, terms. This is the Unix timestamp, so that's a date. Date. Essentially, date and hour and minute and second, right? Measured in seconds, where the expiration of the bond will take place. So boom. So that's great. And finally, set adjustment. So set adjustment, and that was the most important part. Set adjustment was set to false. And then rate was this and target was that. Now, initial UI bug was that despite set adjustment being set up to false, it reflected true. But that was fixed, including on this one, retroactively. That's cool. But there was another issue. But currently, as you remember, the governance was initially launched by the admin. So the admin still has admin rights that have not been triggered at any point in time post governance becoming available to the public. On the mainnet and on probably the next iteration of deployments, maybe on Mortar, we may switch the admin functionality to the Guardian functionality. Guardian is the governance, essentially. In this case, we'll completely relinquish any admin rights to impact the protocol in any way. Now, we can do the same thing on Sepolia. Let's just test a little bit of things just to make sure that it could be done, and then we'll probably relinquish the rights of the admin. On the mainnet, that's the idea. The idea is to relinquish the right of the admin. The admin will not be able to control anything except for deploying the protocols, the smart contracts, and after they have been deployed, the rights of the admin will be forwarded to the Guardian, which is responsible for the governance, right? So the governance will be deciding on everything. So the admin can be setting any changes to the rates. The rates today could be 20,000%, tomorrow APY, right? Tomorrow could be 1%, tomorrow, the day after could be 1,000,000%. So there are no limitations as far as up or down. There's no limitation to the increase or decrease in the APY. However, the built-in, again, policy of Olympus, built-in Guardian policies have been set up to be limited to 2.5% increase or decrease per iteration. That's a legacy thing that could be easily removed. It's very easy to comment, meaning remove it right from the code. However, it's there. And that's legacy. And that's another reason why we know for a fact now, right, that Olympus was not managed by governance, really. It was managed by multi-sig that could have changed the APY left to right. Now, since the APY was set at 20,000%, it was sustainable for 3 months, but one LP bond, I think it was LP bond 8, or RAPTTH bond number 8, became so popular that the supply of eCasper increased significantly. And therefore, because of the supply increase, the backend dropped below $100. And that was the target backend per eCasper based on 20,000% APY. The APY was decided to be dropped. At these rates, the fair APY shall be around 1,000% if you want to maintain the price flow of 50. Now, there's nothing wrong with the eCasper dropping in price because, again, we're not here, like, if the price is dropping, it does not mean you're losing money. What may mean that you're losing money within this protocol is if your market cap exposure is dropping, right? So what has to happen is you need to, like, the backend will be dropping because APY is diluting the backend. 20,000% APY means roughly 1% per day. So every single day, this backend will be dropping at these rates by 70 cents, right? Roughly, which is a lot. So therefore, obviously, it's cumulative percentage, but you get the point that it keeps dropping pretty aggressively. So it doesn't take 70 days to get to $1, but it will take actually maybe even faster. Who knows, right? Like we need to calculate it. I need to calculate it somewhere offline. But if you limit the APY, then the dilution will not be that severe. And the reason why you should not be just, again, focusing just on the price, whether it's back in or the eCasper price, like, oh, I bought the eCasper at 1,000, now it's 200, I'm losing money. That's not how it should be done. You're not valuing the price. You're not valuing your performance based on the price. You shall be valuing your performance based on the price times your exposure. Why? Because while the price is dropping by 1%, by the way, both backend and eCasper price drops by 1%. Why? Because eCasper gets minted additionally into the DEX as well. Even if nobody's buying it, nobody's adding liquidity, eCasper within the pair, this price is determined by the pair. It's eCasper versus WrappedETH. WrappedETH is fixed. eCasper, on the other hand, is not fixed. It's increasing by 1% every day based on 20,000% APY. Now, if APY is dropping, then of course the dilution will be decreased. If the APY is increasing, the dilution will be increasing. So both of these numbers actually drop by 1%, unless somebody buys it, unless somebody buys a bond. Okay? So otherwise, these numbers will be diluted. That's a bad asset. Like this asset is diluting me every single day by 1%. But what you're not counting is the fact that your supply is also increasing by 1%. So effectively, you stay neutral. So while your price is dropping 1%, your supply is also increasing 1%. So you literally flat. The idea then is whenever the price is low on the DEX, whenever the bond has a massive, good discount, a competitive discount, in your opinion, you shall buy it. Why? Because you thus are thinking that the price is undervalued, and I believe the price is undervalued completely. The healthy ratio is anywhere between 5 to 20, and the fact that current ratio for us is about 2 to 3 absolutely indicates that this price is undervalued. I'll explain also some of the reasons why that may be the reason. Secondly, the price may be pretty low as well because the market cap is just 2 million. Now, of course, it's a lot more difficult to capture wrapped ETH through ETH mining, but we did some testing, and it seems like Hoodie, which was not possible to be launched on about a couple of months ago, is becoming more and more possible to launch on. About a couple of months ago, RPC endpoints on Hoodie, public RPC endpoints on Hoodie, did not enable extraction of events. Now, bridging transactions are formulated as events. Since we couldn't capture events from the RPC, the bridging transactions would have been disabled, and therefore it will be essentially no point for us to launch Hoodie as a full simulation. However, that changed. Now, the reason why that has changed, I believe, is Sepoy is going to be deprecating within the next 6 months, and then Hoodie will take over with Haleski and some other testnets. So on Hoodie in particular, it's a lot easier to mine Ethereum. Right now, you can mine about 33 ETH via the proof of work faucet within a couple of hours. That's a lot of Ethereum, 33 Ethereum. And of course, that's reflected in the price. As you can see, the price is completely different. It's 26,000 per FATSO. Now, it's still old names and everything, right? Like still kind of legacy brand here. But as you can see, the discrepancy is 1,000. Now, 1,000 ratio between FATSO price and backend is also unhealthy. Well, it's not 1,000, it's 900. It's also unhealthy. But it's, I would say it's a lot more healthy than 2.5. Like meaning this one, sure, maybe selling pressure needs to be, put on the price a little bit because the market cap is 270. But clearly, when we have, such magnificent protocol with lots of bonds, lots of activity, lots of holders, we're getting more and more holders every day thanks to your participation, ladies and gentlemen. The backend of 70, I think it's significantly understated, and the price, I think, is significantly understated as well. I believe that the backend needs to be increased. By the way, the market value of this, not the risk-free value, but the market value of this is double it. It's about 130, as I mentioned before, and the price therefore shall be 5 to 10x from the backend. So that should be about anywhere from 300 to that's 5, right? 350 even, $350 to about $1,400, and that's going to be healthy. Okay, so clearly, good time to buy. Good time to buy. But I'm just vocalizing my opinion. This is not financial advice, but I believe this is a good price to purchase it to purchase the eCasper itself, it's also an amazing opportunity currently to buy the bond. Now, it's LP bond, so you need to have an LP. How to get LP? Cosmos prepared a very interesting diagram of essential steps. But what you do is you just go to the pool and you pull wrapped ETH and eCasper together, and boom, and you're golden. So for that to happen, you need to have wrapped ETH, which is understood how to get from wrapper, and you also need to get eCasper. Where to get eCasper? Buy it on the DEX. That's why LP bonds push the price higher, because if you don't have eCasper, you have to buy it. Where? On the DEX. So when you buy it on the DEX, you're pushing the price, which is good for the protocol. Thus, you are making the ratio between price and back-end healthier. Okay, let's go back. Let me finish this quickly. So this is so the reason why this transaction did not go through, the reason why we can still execute it, but it's not executable. You can try, but you'll get an error, is because the set adjustment was way too aggressive. It was not within the 2.5% range, up or down, because it was set by the Guardian. And therefore, since one transaction, one function within this proposal fails, the whole proposal fails. So that's the unfortunate set of events, but that's what it is. And that's now the reason why the functions are bulked together is to save on the gas fees, and also to save and to save on governance votes for the users, and also to facilitate governance to be done faster, as opposed to be voting on each of these functions independently. Now they could be chunked together like they're done. For example, for this one, chunked together totally here at 3 functions, boom, and everything went through and it's already executed. Okay. Let me see if there are any questions. Oh, some questions. Ampliforth, thank you so much. Permissionless go. Yeah, permissionless goes. Thank you so much. Ampliforth, yes. Okay. Now, permissionless ghost question. Ghost version 0.5039. Bond offered 100% discount is priced at 0. Market price of 1900 maxed by UniV2. I would get the max at 57 at price. Okay, so you're referring to the same problem that you already outlined in Wales, I believe. So if I try to purchase the transaction, it fails. So first things first. It was an old version. And there was a bug. So let me explain what happened on the old version and why the discount was shown 100%. So the reason why it was shown 100% is 2 reasons. First of all, this price was calculated incorrectly. It was 0. It was showing literally $0. And market price was calculated also incorrectly. How do I know? I actually have a screenshot of it. I have the screenshot of version 0.5.39. Now the bug happened due to, I'm saying different price than what you show. Okay, 1 second. Let me, yes, yes, you see a different price of what I show. Why? Because my version is 0.5.42. So the amazing instant fix is Shift F5 on your computer. If it's a Mac, remove cookies, refresh it, and you have. Pierre told me the same thing. Pierre's like, how come you have like an older version on screenshots? I'm like, oops. But he said that to me in PM. So I think that's the reason why you see a different price. I do apologize. Yeah. So as you can see, so this is a great permissionless ghost. Thank you so much for noticing it. This is a great example of how many updates actually happening on the background, because we have at least 3 versions, right, since like last couple of days. So it has been 3 versions forward from 0.5.39. In reality, I think it was like about 10 versions forward in the last week alone. So multiple versions throughout the day, because we had some bugs here and there. The biggest bug that has been introduced is this. And I'll just explain why that happened, and I'll explain more detail maybe in 5 minutes, right? Because we have a call soon. So when we had Hoodie, can I switch to Hoodie? Maybe I can't. Oh, okay. Maybe Hoodie will take me some time now too. Oh, okay. For the okay, I can't. Here. So on the Hoodie, everything is denominated in DAI. and copying the code. Now, we didn't fork it, we redesigned it. We recoded it from scratch to optimize for tax optimizations, fix the bugs, etc. But inspiration has been majorly taken from Olympus. So in order for us not to make mistakes, right, and take some portion of the logic, core logic, not code logic, but core economic logic, we didn't want to mess with the formulas, including RFE. We don't want to mess with it. The only reason I still don't, I think the biggest thing I don't understand still is RFE. How come it's discounted? Why does it need to be really discounted? I kind of understand it, but I'm not sure if that's really the reason. I just don't know. And nobody knows for reason, for a fact. Except for I have more and more theories about it. Now, when it comes down to DAI, one thing is easy about DAI is its price. The price is $1. Now, since everything is denominated in DAI, or dollars, certain calculations become a lot easier. Calculations of risk-free value, market value become a lot easier, specifically for LP tokens. So the bond is not available on Hoodie, but if it was available, the formula from Olympus would simply work. When we came to Sepolia, that formula didn't work. And there's a whole article published on the blog talking about switch to native coins, native coin backend, and the markdown responsible, in particular, markdown responsible for converting from wrapped ETH denomination to dollar denomination is changed as well. So it's a square root, if I remember correctly, the square root of price of wrapped ETH versus of wrapped eCasper versus wrapped ETH multiplied by the square root of the coefficient. Now, the square root of the coefficient is the initial price of Ethereum when the protocol has been launched. Today, that coefficient is equivalent to $2011.50. So it's very close to this price. Didn't oscillate that much from this price, but it was different. Now, the reason why we need to hard code the $2011.50 as a coefficient for at the time of deployment is because we need to hard cap the minimum backend. With DAI, it was easy, it's $1. If it drops below $1, minting stops. Now here, there's no such thing as $1. Everything is denominated in Ethereum. So therefore, we need to set the price floor in terms of Ethereum. And I believe it's about 0.04977, something like that. That's like the Ethereum price floor. However, if Ethereum increases to $4,000, then the price floor increases to $2, from $1 to $2. And conversely, if Ethereum, say, drops to $1,000, the price floor decreases in dollar terms from $1 to 50 cents. So because that hard-coded $2011.50 was set initially, it was equally set in many formulas on the user interface, including on the bond. Now, since the discrepancy has not been that severe, so $2011 versus 1900, whatever, 80, you didn't even see the difference. Most users did not see the difference, but we saw the difference. We saw massive difference. And since we saw massive difference, massive difference, it was like a couple percent discrepancy, but still important. The consequence of that could be severe. We decided to make changes, and the changes that have been made on the version 0.5.39 have not been accurate. So what happened was this became incorrect and this became incorrect. And that's why your transactions failed. And maybe that's why some of your purchases have not been profitable. That's not because you made a mistake. That's because UI was wrong at that moment. And maybe that's what caused the mistake. Okay, that's what caused the unfavorable trade. However, now it seems to be fixed. We checked. That's why both bonds have been deployed, both wrapped ETH and LP bond at the same time. Although wrapped ETH bond was not necessary for the protocol, it's LP bond that are increasing the ratio of the coefficients. But both have been set for us to check the pricing. The pricing turned out to be correct, at least for that moment. So we took a deep breath and said, amazing. Okay. Any other questions before we end? So today we discussed the overall updates. The price dropped, this thing dropped, but the supply significantly increased, which is great. We have more and more holders, which is great. That's exactly what the protocol needs. More distributed ownership of eCasper. We have multiple bonds. All the bonds can be found on the proposal page here, without exception. And secondly, on the forum. So every single proposal so far, at least, has been accommodated by a proposal, like a description on the forum of what this proposal means in easier terms. Okay. Last question from Scorpion. Well, in case you guys have other questions. So to be sure I understand, if the price ETH or other native tokens go up or down, the backend equally fluctuates, and I would assume the need for the new bonds will be altered. That is correct. So in dollar terms, the price will fluctuate. However, the price floor will still be fixed at the price of Ethereum set at the beginning of the launch of the deployment. And that's done on purpose because if the price floor oscillates, then we can say, hey, listen, like, it could be 50 cents, it could be 25 cents. It's not hard capped. So we need to make sure it's hard capped to give confidence to the entire protocol that, listen, yes, the eCapsper supply is diluting. Yes, it's expanding. However, it's not expanding below a certain value. Once it reaches a certain value, dilution will stop programmatically. So that way we are protecting everybody. And while it may sound, hey, listen, it's $69 of backend versus, say, $1 of price flow, how does it protect me? But think about this. Unless there are new bonds and new supply, in order for the backend to drop from $70 to $1, the price has to drop by a factor of 70. So essentially, in approximated terms, the supply that you personally hold and everybody else personally hold in eCasper, if it's staked into Casper Casper, will proportionally increase by a factor of 70. So the fact that the price is $1 doesn't mean anything because you'll have a much, much bigger supply. Essentially, instead of, let's run this up to 10,000 supply, you will have 70,000 supply with $1 backend. And the idea for the bonds is to make sure that we can extend extremely aggressive APYs for much, much longer while keeping the backend above $1. That's literally what the policy is. That's literally what we're trying to optimize for through APYs and bonds. Bonds obviously attract liquidity and wrap ETH into the protocol, while APYs make it gimmicky, make it marketing amazing to the users. Permissionless Ghost. New Ghost DAO version unable to log in with MetaMask, trailing controller, keying, metadata, length, mismatch. Shift F5. Perhaps the best way is to disconnect from everywhere, especially if you access it through the phone. Disconnect from everywhere, from your MetaMask, like from everywhere. Just completely disconnect from all the sources and then reconnect. It's a MetaMask issue. It's clearly not the issue of Ghost DAO. All right, ladies and gentlemen, thank you so much for your attention. We'll see you next week. Have a good one. Bye-bye.